Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at applied digital.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
I think the place we have to start with applied digital is just how completely different the story is today compared to, just a year ago?
That's exactly it. A year ago, it was all speculation. It was, rumors, potential heavy investment, a construction story.
Right. A lot of hope about what they could build.
Exactly. Now it's an execution story. The question isn't, will they do it anymore? It's, they did it, and here are the results. That pivot is really confirmed in these Q1 2025 numbers.
So it's not just promises anymore. This is operational reality.
Yes.
Hitting the balance sheet.
Okay, so break that down for us. What do those hard numbers look like? What does this new reality actually translate to?
Well, the big one is total revenue for Q1 2025. It hit $168.4 million. Wow. And what's the growth on that?
That's a massive acceleration. It's a 53.6% year-over-year growth. But honestly, it's the quality of that revenue that tells the real story here.
The quality, meaning where it's coming from, right? Moving away from the less predictable stuff.
Precisely. The core driver now is AI. Services for AI and machine learning workloads now make up 62% of their total revenue. That's $104.4 million.
So they've really cemented themselves as a pure play for AI infrastructure.
They have. It's a decisive shift.
Okay, revenue growth is one thing, but, building these giant facilities costs a fortune. Is that high top-line growth actually turning into real profitability? How are they managing costs?
They are, and this is where their whole model really starts to pay off. We saw a huge improvement in margins. Gross margin expanded to 44.8%.
44.8%. For anyone who isn't deep in this sector, what does that number tell you? Why is that so important?
Well, it's an 860 basis point jump, so almost 9 full percentage points from last year. That's critical.
So for every dollar they bring in, much more is dropping to the bottom line.
Exactly. And it's not luck. It's because their big facilities are running near full capacity, and they have these fixed-fee power contracts that, protect them from volatility.
Got it. And how does that strong gross margin translate down to adjusted EBITDA? That's the metric everyone watches.
It flows down very nicely. Adjusted EBITDA came in at $62.1 million, which is a really healthy 36.9% margin.
That sounds like it gives management a lot of confidence.
It does. They've reiterated their Q2 revenue guidance, somewhere between $175 and $185 million. And maybe more importantly, they've stuck with their full-year EBITDA guidance of $280 to $300 million.
Okay, so that's some solid forward visibility. How has the market reacted to that kind of guidance?
The analysts have reacted very quickly. We're seeing 2025 EPS estimates being raised by about a third, from around 82 cents up to $1.09.
Which basically signals that the big money believes this performance is sustainable, right? Not a one-off quarter.
It's a huge de-risking signal compared to where they were just 12 months ago.
So that's a remarkable transition. But this space, data centers, it's incredibly competitive. What's their actual moat? What's the aha factor that stops a giant competitor from just eating their lunch?
The aha factor is their entire infrastructure model. They call it the vertically integrated digital campus.
Break that down. What does that mean in simple terms?
So think about it like this. Most data centers are just tenants. They rent a building, they buy power from the utility. Applied Digital, especially at a place like they're here on campus, they've built the whole ecosystem.
They own everything.
They own the land, they've optimized access to power generation like local wind and solar, and they own the facility itself.
Okay, so they control all the inputs. What's the bottom line benefit of doing that?
It all comes down to one thing: power cost leadership. It's a structural advantage. Because they get their power direct, under long-term deals, they're getting it for sub $30 per megawatt hour.
Sub $30. I mean, put that into context. What's the industry standard?
The national average in the U.S. for commercial power is around $51 per megawatt hour.
So they're getting their single biggest input for, 40% less than average?
About 40% below average.
Yeah.
And it's not a temporary sale. It's baked into their model. It lets them sustainably underbid competitors for these huge long-term AI contracts.
That 40% is a massive difference. And if power is the key cost, I feel like water is the new unexpected liability for this industry. How does their model help there?
It's a huge environmental edge. It's all about their cooling tech. They use air-cooled servers,
Meaning,
meaning zero water usage for cooling. This is a game changer. So many of their competitors rely on these massive water-guzzling chillers.
and with droughts and regulations, especially out west, that's a huge operational and, frankly, political risk they just don't have.
Exactly, especially when you're trying to win contracts from hyperscalers who are very focused on their ESG footprint.
Right. It makes them a much safer bet. So what about keeping these valuable customers? How sticky are they?
Extremely. The average customer contract is now 4.7 years long,
And the peer average is what?
usually hovering around 3.2 years. So that extra year and a half gives them incredible revenue visibility and really reduces their churn risk.
Okay, so let's move from the competitive moat to the actual financial health. How's the balance sheet looking?
This is probably the most reassuring part of the story. It confirms they're managing this insane growth responsibly.
What stands out is the deleveraging story clean.
Oh, it's absolutely clean. Cash reserves are way up to $241 million. But the headline is the net leverage. It's down to a very, very healthy 1.0x.
1.0. Why is that considered so healthy in a capital-intensive business like this?
Because it means they could, in theory, pay off all their net debt with just 1 year of operating earnings. It gives them so much flexibility for future expansion. It's a massive signal to the market.
And free cash flow. I mean, that's what you need to fund growth without going back to the market for more money.
It's impressive. It surged 317% year over year to $72.3 million in the first quarter.
And what are they doing with all that cash?
Putting it right back to work, reallocating it to growth capex so they can fund their next expansion phase without taking on a bunch of new debt.
Is there any talk of returning capital to shareholders? Or is it all growth all the time?
No, there is. Management has been pretty clear that a formal share buyback program is expected to be announced right after the Q2 earnings call.
Really? That's a huge sign of confidence.
It shows they believe they can generate cash well in excess of what they need for growth.
Which brings us to market perception. When the fundamentals get this good, the institutional money usually shows up. Is that happening?
Oh, it's happening in a big way.
Yeah.
Institutional ownership jumped from 38% to 52% in just 1 quarter.
And we're not talking retail money here.
No, this is the smart money. Funds like Fidelity, Point72, Viking Global, they've all been buying in. When you see names like that on the shareholder list, it's a
Okay.
powerful signal.
And what about insiders? Are they putting their own money where their mouth is?
Yep, the CEO made a big insider purchase, 50,000 shares, back in March. That's about as bullish a signal as you can get.
Okay, so we've got the fundamentals, the moat, the financial health. What's next? What are the near-term catalysts we should be watching?
Well, looking at the roadmap, just this past April, they announced a huge new contract.
Right, the $120 million one.
Exactly. For 20 megawatts of capacity with a Tier 1 AI provider. That delivery is for Q4 2025, so it gives you revenue visibility deep into next year.
And the analyst community is starting to really take notice.
They are. The endorsements are flowing in. Barclays, for instance, upgraded them, and they specifically called out the best-in-class power economics as the main reason.
So on the technical side, is the stock chart reflecting all this good news?
It absolutely is.
Yeah.
You see a really bullish structure building since that turning point back in March. There's a confirmed double bottom, a series of higher highs and higher lows. It looks like classic accumulation.
And I saw talk about a golden cross. For our listeners, can you just quickly break down what that signifies?
Sure. A golden cross is when the short-term 50-day moving average crosses up and over the long-term 200-day moving average. It's widely seen as confirmation that the momentum has shifted for the long term.
A major structural shift.
Exactly. It suggests the institutions are really in control now.
So what dates should people circle on their calendars? It sounds like there's a lot coming up.
The calendar is packed. First up is May 8th for Q2 earnings. Consensus is already high, around $180 million, but the chatter is they're set up for a beat.
And then the really big one.
May 28th, Investor Day. That's where we expect the major long-term reveals.
Like what?
Phase 2 capacity details, 2026 revenue guidance, which something could top $750 million, and crucially, the specific details on that buyback plan.
And outside of the company itself, there's a potential macro tailwind to come in too,
Right,
Ro.
huge one. If the Fed does start cutting rates in June, as many expect, these kinds of capital-intensive infrastructure stocks could really outperform.
Okay, we've laid out a very compelling bull case, so we have to do this. Let's address the bear case. What's the biggest risk here? What's the
Okay.
catch?
The primary risk, and we can't ignore this, is concentration. Customer concentration.
How bad is it?
It's high. The projections suggest 78% of their 2025 EBITDA will come from just two customers.
Whoa, hold on. 78% from two clients? That's terrifying. I
Yeah.
mean, how can you be confident when the loss of just one of those contracts could crater the whole story?
It's a fair and critical point,
Right.
and it's honestly the main reason the stock isn't trading higher. That risk is priced in.
But how are they mitigating it?
Well, first, that 4.7-year average contract length helps a lot and provides stability. Second, they are actively diversifying. They've got a new customer pipeline of over 25 megawatts in due diligence. Chipping away at that 78% is a major operational goal.
That makes that Investor Day pipeline update incredibly important. What about interest rate risk? You mentioned the Fed, but their own debt must be sensitive.
It is, and some of it is variable rate. But they've been smart about it. 88% of their current debt is either fixed or it's swap hedged all the way out to 2028.
So they're insulated for the near term.
For the most part, yes. And because their free cash flow is growing so fast, the plan is to fund future expansions organically without taking on a lot of new risky debt.
Okay, last question on this. Despite all the good news, the stock isn't valued like an Equinix or a Coresight. Where does the valuation stand right now?
And this is key to the whole asymmetric upside argument. Even after the recent run, their valuation, so EV to EBITDA, is still only around 7.8 times.
And the peers are trading at what?
Established peers like Equinix are north of 21 times. Coresight is near 18.
So there's a huge gap. The market is still skeptical.
The market is still partially pricing them like an old-school, levered crypto miner, not the AI infrastructure powerhouse they've become. If they just deliver on that EBITDA guidance they've given, that valuation gap should close, and that's where the real upside potential is.
So the risk is known, but the potential reward, if they keep executing, is disproportionate.
I think that's the best way to frame it. So to summarize the whole thesis,
Yeah.
Applied Digital is really uniquely positioned. It's a pure-play AI infrastructure developer that has mastered the cost side of the equation.
Right. That low-cost power is the core.
Exactly. Vertically integrated, 40% cheaper power, combined with rapidly accelerating fundamentals, 54% growth, expanding margins, and a deleveraging balance sheet. It's a combination that has, finally attracted the big institutional money.
It's a really compelling story of an operational pivot. They've gone from a hope-based stock to one driven by measurable financial success, and they do it in the single hottest sector of the economy.
Right.
And that multi-year runway, especially as AI demand just keeps growing and they expand into phase 2, it really does feel like this is just the beginning of a much larger story.
It could be, yes.
Make sure you subscribe and hit that like button to follow us, and we'll catch you on the next deep dive into smart wealth with Joshua.